Another topic came up recently, and I figured not many people are speaking about this one specifically. I figured I would go ahead and do so. And it's something near and dear to me, as you've heard me talk about on numerous projects as a failure of the crypto business. And they struggle with why it's a problem. And despite my every effort, many of the tokens simply don't want the smoke where I could help them. And so I figured, let me go ahead and put it out so I can contribute my thoughts on the issue and why it's an issue and what I suspect are the solutions to the problem. And I'll do it for free, which I normally wouldn't do. But it's around this concept of anti whale. In order to break this down, I've got to give you some definitions. First of all, what is a whale? You probably have already a high level sense of what it is, but a whale is a person who's invested in the project and holds a significant percentage of the total supply by way of their investment or by way of them being given the tokens. So if you imagine that, let's say your token supply is 1 million tokens, right? If somebody I would argue, in percentages, held 10% of that, I wouldn't call that a whale necessarily. Once you start getting to 20%, 30%, I would classify that as a whale because of scarcity. As your token supply grows, that percentage is going to decrease because it really goes to then the percentage of liquidity that the person would remove if they were to cash out. So when you're talking something that's got a quadrillion tokens, your 20% isn't going to really move the needle that much if the token is just launched because there's not enough liquidity yet. Once it has a significant amount of liquidity, that percentage becomes ever more critical. You see tokens all the time. If you use on the Binance chain marketmove.ai, you see all the time that sometimes a token has like 100,000 or 400,000 or 1 million in liquidity, but the tokens that the top holders hold is like 7 million, 8 million. And you're wondering, well, what the heck is going on with that? Once you get to a point of insolvency is essentially this token no longer is making enough to support the whales that are in the project, and its supply is too constrained in order to expand properly to truly be deflationary. Let me break that down a little bit. If I've heavily constrained the supply so that the price goes up faster, your buys are going to slow down. Why? Because when people look at the price and they see a price that's like, it starts at like $10, right? Somebody might throw in a little money on a $10 something. If you're like Seifu and you jump to $330 per coin, your new investor coming in sees 330 per coin. They're not going to buy as much if they buy at all versus what they would have done if it was still $10. This is obvious. Sticker shock happens all the time. But the people that bought in at 10 that sat on it, they now have millions and millions of dollars worth of value. As people dump the project, you're losing liquidity. And it gets to the point where it starts to be insolvent because if enough people dump the project, you may not have enough liquidity to support the rest of the people still in it. And if those people were to dump out, it then goes to essentially zero in the liquidity. The liquidity is what makes things happen. No liquidity or low liquidity is a dangerous situation. This is what was harming Drip, as an example, and why we called it an MLM, because that's what it is. This is what happened with Titano, where they blacklisted that whale because that whale was smart enough to buy in and they spent just enough that they had so much freaking money that their sales harmed everybody else. So for people that say it can't happen, of course it can happen. We see it all the time. It's a common thing, which there's only one problem that is caused by this, which is that the token eventually is going to fail. Now, when we talk about whales, we have to understand that they're necessary to the success of a token too. Because if you don't have whales, you're not going to get significant, quick price movement if the inventory is constrained. Even if the inventory is not constrained, let's say it's in the quadrillions, you need the whales to quickly consume how many tokens are out there. There's so much supply. The whales are the only way to chew through it. That's why you see news and alerts on social media talking about this whale just bought millions of SHIB or billions of SHIB or trillions of SHIB. And then you're wondering, well, why doesn't the price move? Because their supply is too dang large. You'd have to have a lot of those whales chewing through it in order to make a dent in the actual price and move the price needle a little bit. So it's a two-way street. It's a kind of a dichotomy. You need the whales to be in the project in order to move the price quickly. But the whales can also damage the project if it's not managed correctly and if the supply is not what it needs to be in order to manage that expectation. So the gimmick that every token, pretty much everyone, not all, but pretty much everyone does, is this concept of burning, and the concept of burning the liquidity, and the concept of burn and liquidify, and the concept of buybacks, and all these other gimmicks that they throw at the problem, which is designed to try to defray the loss of liquidity. All the time, if you think about any other product on the market for anything, not even crypto, liquidity always has to be there. If you have a corner store, drugstore, they have to have money in the register. If they don't have money in the register, they can't give change. We can assume that every single person walking in there is going to use a debit or credit card, but we can't necessarily guarantee it. There's always going to be 1 or 2 or 10 or however many people who will want to pay with cash. And having cash in the till also is a little bit of insurance. Let's say that you have somebody's transactions too darn small to justify the fees for the card. You might force them to use cash under a threshold. It's actually against the rules, but they do it all the time. You might need to do what's called a cash transaction, like $5 something for, let's say I need to go down and I need to buy some food for people. And you wouldn't want to put that on the books. You just use it as petty cash transactions. So they keep cash on hand. Having cash on hand is an expectation. It's the reason banks exist, fundamentally, is to make cash available. That was the initial intent and purpose. The cash is the equivalent of liquidity. In crypto, it's no different. They always have to have liquidity. But in crypto, they can't just artificially make liquidity. It has to come from somewhere. Somebody's got to buy it, or somebody's got to donate into it of their own. Like if they come in as a billionaire and they toss a couple million into the liquidity pool up front, they're creating surety, as in assurance, in the project with their own money. They're putting their own money up. What most tokens do instead is they'll do the ICO/IDO/ITO process, which is essentially crowdfunding, to offer the tokens, usually at a discount, in a pre-sale fashion to build that liquidity pool. That would normally work. The problem is that you're going to have people who sell out. As people sell out, if more people sell than that buy, you're going to hit that insolvency situation. There's numerous tokens that launch pre-sale. This is the reason we call pre-sales under pink sale a risk, because we know that you're going to run into that. It's basically like a pump and dump type thing. And if you can't sustain the buy pressure, if you can't keep people buying into this thing, you're not going to be able to sustain the liquidity pool. So what many tokens decided to do, and this started in 2021, from what I saw, I might ask Believe sometime, but I saw that it started in 2021. There started to be this paradigm shift into this anti-whale mechanics. And we started to see all these gimmicks around anti-whale. First of all, I'm morally opposed to the idea of an anti-whale. You heard my coverage about the whole Titano situation. I don't believe we should do things that are anti-whale. I don't think it's the right answer. Some tokens need something that prevents whale behavior, but I'm not against an anti-whale mechanic. So an anti-whale mechanic, now that we got the preface, now here's the definition. An anti-whale mechanic simply says, I'm doing something that stops a whale from doing what whales do. That's at the core what it is. But they do it in a way that limits their ability to sell or makes it a disincentive to sell. Okay, but taxes were the way that they decided. Let's just create high taxes on cells. And so you see projects that have a high cell tax. And you're like, how does that take form? Some people thought it was gas. It's not gas. It's slippage. If you're on the Binance chain, this is even worse, because you'll see like, yep, set your slippage at 30%. Just so you understand what slippage is doing, it's a simple, because it goes to this. Slippage is basically you telling that tool, I'm willing to lose 30% of whatever it is that I'm trading just to make the trade happen. it's kind of a ghetto equivalent to a limit order, because a limit order in the exchange, that's essentially what you're doing. You're setting a price that you want to buy or sell at, and then you're setting the total amount that you want to buy or sell, and you're hitting the button, and it may or may not go because people are not offering at that price. So then you may have to offer a little bit lower or a little bit higher to get it to go based on whether it's a sell or a buy. So this is a ghetto equivalent of what that limit order methodology is, that you are using slippage to basically throw away money in order to liquidate or sell or get profit. And many people are against taxes. I'm one of them. But the taxes support things like liquidity rebuilding, because you're basically charging a fee for them to sell, and then you're taking some of the proceeds of the fee and you're tossing it back into the liquidity. There's a smart aspect to that, right? Or you're doing the sell tax for generating reflections for people. There's a smartness to that. All these are smart, but whether or not they're practical, whether or not they're sustainable, whether or not they're truly effective is still up in question. So I'm going to give what I think about the whole mechanic. I think we're doing it wrong because what we're trying to do is we're trying to apply things against sellers, and in some cases buyers, because sometimes they have the tax both ways, that make it to where people don't want to do it. I think people see that and they realize the slippage is going to nail them, and they don't want to go that route. They realize that this is a ripoff, essentially. In a lot of cases, it's so high, it's a ripoff, and they're doing it because they're trying to stabilize. And in truth, it doesn't stabilize, because at the end of the day, if you build this mechanic to take a 30% tax on somebody and you burn and liquidify it to go back to the liquidity, it's not going to matter if the volume goes down, because people aren't doing it because they see that same tax and then they stop buying in. It's like a Ponzi scheme in a sense. You're banking on activity that you can't sustain because you have this mechanic up front that is not friendly to the investors, all because of the real risk that people dump on the project. So it got me thinking, and I've been thinking about it a while. Maybe the problem is stopping them from dumping on the project. And we say that, and it sounds simple, but it's harder than that, because you're always going to have those people who all they care, it's like day trading. All they care about is making the quick profit and moving on. But have we ever stopped to ask the question why that is? Have we ever stopped to analyze why there are those people that do that? Because maybe we can get inside their head a little bit by asking them and create a solution that works for them, lets them do what they're doing, but preserve the project's price model. I think Libero came close with the bank, because the bank helped stabilize the price. Those that were invested in stabilizing the price contribute to the bank, and there's a lot of those people. Those who want to day trade it like anything else, they can do it, and it lets them do it. It doesn't stop them. It does charge a pretty significant sell fee, but they can't stop reacting to the green candles of the stabilized price. They see it, they FOMO, they can't help themselves. I don't necessarily agree with the sell fee because, again, I think it's a disincentive to where it could be. But in their case, at least the bank allows the people that are serious about it to add to the stability and play a part in keeping the price stable, and then take passive income for those that are smart enough to take profits on the way up. But let's flip it around. If we expect that people are going to dump primarily because they don't believe in the project, they think it's a crap shoot, and they're not going to leave the money in it because they don't think it's going to be around. So let's say that's the reason why some of these are just pumping and dumping the token. It's that they don't believe in it. They don't think it's going anywhere fast. Okay. What if you had a mechanic that's treated as anybody can buy, anybody can sell, any time of the day, not like that dream garbage that I covered some time ago where they want to treat it like the stock market, because that's the wrong approach to me. But you can do it any time of day, just like you normally do. We don't charge taxes. We don't charge fees. We don't charge any of this stuff. We try to keep it rock bottom. If we do charge a fee or a tax, it's based on a condition that we test against. So let's give a scenario, and I'm trying not to spoil too much because I don't want to give away for free, but let's take a scenario. Let's say that you launch a token. Token goes live, everything's all good. You know that every single launch token follows the same pattern. We know that they all are going to have the initial pump, and there's going to be a dump and a bunch of people selling. What if, just suppose, what if you were to say there's a time span between when you bought and when I allow you to sell, and if that time span has not passed, you cannot sell? So rather than blocking them completely, we're not saying you can't do it completely. We're saying you can't do it right away. You gotta wait a little bit. Why does that make any sense? If you think about your bank, if you were to deposit a check, they may make some funds available to you right away, day one, $200, usually in the United States. But they're not going to let you transact that whole check the same day unless it's like a government check, for example. Generally speaking, if you did an ACH and you sent to somebody else's, the ACH on the other side, once it credits, it's available immediately because they receive the funds immediately. They don't care if they sell them after that point. But the check is held. The check is not immediately made available right away. If you had a certain level of transaction that makes a credit card uncomfortable, they will put a halt on your card. They'll say, wait a minute, we're trying to protect you, so we're not going to let you do a transaction. It declines, and you got to call them. It's annoying, but what it does is it also makes sure that it's truly legitimate and you're not just trying to rip the card off. All these different mechanics makes you think maybe those guys are onto something rather than a complete, taxation method that doesn't help because it just kills volume because nobody buys in. What if you simply say there's a delay that we don't communicate between when you buy and when you sell? What if, as part of the contract, you communicate what that expectation is going to be and you randomize it? And then over time, that time span diminishes, it goes down. So let's say you bought in on Monday. We run a random calculation. We say, you know what, we're going to hold this for one day. So tomorrow you can come back and you can sell, no problem. Next time you do it, if you kept any, then that duration goes down. If you kept any, it goes down. Kept any, goes down. So you can sell as many times you want. It's still going to delay you, and then it gets faster and faster because you kept some. So you're taking profit. We know you're taking profit. But if you dumped completely, so you bought 1 million tokens and you dumped it completely, you completely liquidated it. Okay, wait a day. Let's say the randomizer comes as a day. Wait a day. Go ahead and dump. Cool. You try to buy back in? Nope. Got to wait a day because we know what you're doing. We know you're trying to pump and dump it. And we actually want the price to go up before we allow you to buy back in. What if we do something like that? At that point, we're not stopping the whale from doing anything. What we're doing is we're controlling their behavior so that they're not able to manipulate the product's price with just the regular pump and dump things. But if you're the kind of person who's just taking profit, you can still do it, and we communicate to you when you could expect to get your funds out so that you're aware. You just say, okay, come back tomorrow and we'll give you the next chunk. No problem. Some people might say, well, that's not fair because what if the price tanks? But that's the risk, right? That's the risk you always take. If we're doing it correctly, though, the price should not tank to a heavy degree because nobody could dump. It may steadily go down, but your losses would be incremental. We're not talking significant amounts of losses if it's done right. That's just one example of the kinds of mechanics I think that the business doesn't fully think about. Creative ways of managing whales, not blocking whales, not excessively taxing whales, but managing whales to let them do what they're doing, but do it in a way that is sustainable to the project and make the contract truly smart. Now, the combative folks out there will say, well, what if they just spin up multiple wallets? Great. We actually like that because that's more holders, right? And it doesn't matter because you're going to get a reset clock. It actually is to your detriment to spin up a different wallet. I have other ideas as well, but it's a disincentive to create multiple wallets then. Because if you create multiple wallets, each wallet's going to be reset on the timer. I don't think you want that. There's a whole host of other ideas and suggestions. And if I can get one of the tokens to want the smoke, these are the kinds of things I would talk about with them. ways to help keep their project sustainable without completely turning off people from buying into the project, but helping the whales by managing them, letting them do what they do, but making them understand that they're not going to be able to just completely dump on it either. They can take profits, and that's perfectly fine, and we want them to take profits, but they're not going to be able to cause detrimental harm to the rest of the investors that actually do believe in the project long term and want to hold it. In summary, we can keep trying to make anti-whale mechanics all we care to. We can keep trying to create taxation all we care to, but I believe taxation at its core is going to cause many people to stop buying into many of these projects, and they're going to start looking for projects that don't have taxes or that don't have excessive taxes. The challenge is that almost all of them have taxes of some kind, which I think is a step backward. I think we need to get smarter about how we manage the whales rather than trying to force that mechanic down people's throats and use actual success of the token to drive things like the marketing wallet and other things, to say, because it is successful, we are able to leverage the success to increase our marketing wallets. Right now, taking a portion of the tax and funneling it to the marketing wallet's all fine, but as the popularity dwindles, is that really sustainable? I don't think so. That's my thoughts on it. Comments, questions, suggestions, feedback, feel free to leave them. As long as you're respectful, I will acknowledge you, whether here or on cryptotalkradio.net.